Well, ladies and gentlemen, we know it all. Why don't we just do what they are saying? And we have the solution. Well, the last panel this afternoon is about global capital standards. And we have for you a panel here, which is global, not completely global, but we go a long way to be global. And I have next to me Michael Consedine, who is the Insurance Commissioner of Pennsylvania. Mike is very well known as the international face of the NAIC. We see Mike regularly at different conferences representing the views of the NAIC. And next to him, we have Makoto Okubo, General Manager, International Affairs, Nippon Life, Japan. Mako is actually, to describe him, I would say he's an insurance philosopher. So it'll be very interesting to hear from him. Then we have Thomas Wilson, who is the Chief Risk Officer of Allianz in Germany. He's a man who loves risks because he knows how to deal with them. And last but not least, we have Klaus Wiedner, who is, of course, Head of Insurance and Pensions at the European Commission. And he is the man who finalized Omnibus 2. So this is the recipe, this is the menu we offer you this afternoon. And let's go straight ahead with Tom Wilson. And Tom, we heard it all over the day. We heard it again in the video. 3 capital standards in less than 3 years. Is that a realistic proposition? Are these deadlines realistic from a company perspective? And if these timelines are not achievable, what would you suggest to do?
Carol,
it's on.
It's on, perfect. Thank you very much. It's an interesting question, and I think we all have a hypothesis with regards to the answer. Obviously, if you take the alphabet soup that we're facing, beginning with Solvency II here in Europe, then moving on to the direct implications for being a GC, the LRMP, the SRMP, the RCP, the RSP, moving then to the BCR, the HLA, and the ICS, all within 3 years. And each one of those focusing on a process which I wrote down here is debate, define, test, refine, debate, and repeat. It's really going to be a challenging, not only for companies, but also for the regulatory framework. And I especially emphasize that the regulators as well, because it seems as if as we focus on the next hurdle, we're forgetting to finalize what we left behind. So very specifically, under Solvency II, for example, while there's been substantive progress made, there's still significant outstanding issues that need to be addressed, such as the credit risk adjustment, the volatility adjustment. There's a variety of issues that aren't going to come about until year end or middle of next year. And unfortunately, according to the timelines, I have to apply for an internal model with a frozen model well before the landscape is finalized. BCR, it's certainly simpler, but there are still a lot of open issues and that may or may not be resolved. The open issues with regards to liabilities, own funds, the calibration, what will it be? Will it be binding or an indicator? And we're getting even less certain as we progress onto HLA, et cetera. And even the recovery plans and the resolution plans are still open questions. So it strikes me we've got a busy agenda looking forward. There are timelines that are being defined. Our ability to hit those timelines would certainly be improved, or the odds would certainly be improved if we closed some of the open issues as we progress through these timelines. It is very difficult to, for example, apply for an internal model when the target's still kind of moving. It makes it even more difficult to respond in a favorable way to, for example, HLA, when we don't know whether or not it will impact on a broad brushstroke basis or only NTNI. That uncertainty makes our implementation efforts complicated. In addition, the implementation efforts themselves are inherently complicated by the amount of controls that we need to put in, the documentation that's going to be required. Each one of these capital standards will require full reconciliations. Any errors are going to be very critically looked at as regulators. This is not kindergarten anymore. This is serious stuff with serious consequences. I'm sure that the international regulators are going to take them seriously. So there's a lot of control processes that we need to put in place, and the timelines are certainly very critical. If I had to give advice with regards to this, it would be to keep it simple, to try to reuse whatever is possible to reuse, and recognize that these timelines, if you read the rules that are being written, no one's going to pass them. So make sure that everybody understands that implementation's on a best efforts, and there has to be some kind of forbearance with regards to the implementation path along this path. It has to be a collaborative effort, otherwise there's no way anybody's going to be successful.
Yeah. But Tom, if you say, on the one hand you say, well, keep it simple, on the other hand say you have to close all the issues. Isn't the fact that we have to close all the issues one of the reasons why it gets very complicated and takes a lot of time?
Possibly. It depends. Now we're going into an area that I think is very important to discuss, and that is what is the purpose of all of these, exactly, which I've purposely kind of avoided up until now. If the purpose of the BCR, if the purpose of the ICS is more as a safety net indicator as opposed to a binding capital standard, I think that people would probably be more relaxed. Unfortunately, the intentions behind the HLA and the intentions behind the ICS have not been clearly stated. And as a consequence, right now, I think a lot of people in the industry are quite defensive about it because we don't know whether it will be a catch-all safety net for 10% of the firms or whether it's going to be the de facto defining standard for 100% of the firms. And that uncertainty itself is causing a negative reaction and challenges to implementation. I think that one question, if we could answer that, would probably help the process along the most.
But as a major player, what do you really think is necessary worldwide? Would that be a useful thing to have that safety net agreed internationally?
A safety net that triggers based on a 10% as opposed to a binding constraint for 100% of global firms, I think is useful. I think the objective of getting 100% binding constraint on an international is going to be is a much more challenging basis.
Okay. Well, thank you very much. If I can move on now to Klaus. We heard this morning Commissioner Barnier was saying that. We also heard Sergio Balbino, also Burkhard Balz talked about it, about the interrelation between what we have been doing in Europe and the international developments. What is the Commission doing in order to prevent that there is an incompatibility between the two? Because that's I think the $1 million question. Well, I would say the 1 million euro question on that issue. What can you do to comfort people here in the audience?
I'll try my best. Obviously, but it's true that it's coming at a moment where we've just, after 13 years, been mentioned a couple of times, we've finished our European supervisory system, basically, and we have it there. So now, and I think you felt that also this morning, Burkhard Balz, also the Commissioner, said, oof, we got it. And now it's not, really the moment where politicians want to look further and say, okay, what else should be done? But okay, this is as it is, and I think we need to, and we will try as European Commission to be as involved as possible and see and accompany the process. But I think it was clear also that doesn't mean that, at least from the European Commission, we would think that it's not a good thing to do and to try to create a global capital standards. The question will be, how can we get there to an acceptable one, as always? I mean, and one part of it is also, why do we need it? I mean, that makes a big difference. I mean, if you look at the systemically important insurers, I think here the background is clear. It's a question of financial stability. If you look at the international active groups, then we have to see how we define them. Is it a question of financial stability, or is it also, I imagine it is also a question of supervisory convergence, about level playing field, and about then finally also facilitating access to different markets. So I would suggest that this is a bit of broader objective than only financial stability. But that we will see exactly then how it's going to be developed. But if it's this what we want, better access to markets and more supervisory convergence, then we would need really a comparable system, and a system that probably goes further than a simple benchmark. Because a benchmark would be nice just around and say, okay, oh, here there's a problem, and it makes sure that from a financial stability point of view, you say, okay, here it's going wrong, I have to intervene. But if the objective is furtherance, try to really create a global capital standard and have easier access to market supervisory convergence, then you need something more. And then I think you need something that is coercive and that is accepted around the globe and is obviously more difficult to achieve. I mean, from our point of view, we don't rule out neither the soft, nor the hard measure. But obviously, for us, I think, and at the Commission, I think they declared this morning, we would not want easily to give up, the core things that we think we have achieved with Solvency II, which means basically, group supervision, group capital standard, market valuation, total balance sheet approach. There's a number of things that we think are key in Solvency II, and giving this up now would be basically a step back. That's at least our idea. But I think we are overall trying to follow that, and we're in principle open, as the Commission said this morning, even to Solvency III. But we want to be, the cost-benefit analysis has to be right. We need to be convinced that really there's something added value to it.
Can I ask you in public a secret question? Is the Commission working on Solvency III now?
No, I can assure you that there's no intention. We have to, as been said, I think we're a bit quicker. We have the political agreement now, which has been mentioned on the level 1. The delegated acts, the Commission normally should be adopted the latest in September, so we will have normally clarity unless Council and Parliament object, but that's very unlikely because we are in the process already now discussing with the European and the Council. So everything will be there in time, I think, for 2016 for the system to start, which means that there's no appetite at the moment to, in the short time frame, to change, and that is in particular if it's a wider approach to international active groups, because we wouldn't. The question is then how many European undertakings would then be targeted? That's very difficult. Maybe in the medium term would be easier to focus on the G-size than on the international active groups. But that we'll have to see how the work develops.
Maybe something that may be of interest to the audience also, and I think Sergio mentioned that this morning, is do you have the feeling that the Europeans are aligned? Are the troops aligned? Is there a battle force ready, or what are you doing in terms of ensuring that industry, member states, supervisors are on the same picture? I think that the Commission also mentioned something about that, I think.
Yeah, we're trying to play a role there. Obviously, as you know, it's standard setting in particular by supervisors. The Commission at the moment is not a member of the ExCo. The IAIS is basically the supervisors. So what we're trying to do is to have, and I think that was also clear from the Commissioner and Burkhard this morning, there has to be some legitimacy in the debate. Because there has to be an open, transparent discussion about what is going to bring us, and then I think if that is achieved, a kind of more consensual approach, then there will be no problem also in implementing that in Europe. Because whatever it is, since now we have Solvency II, we have full harmonization, which means that any change, will it be to G-size or to the national active groups, will require a change in Solvency II, which means that you have to go through, if it's a hard standard. So we'd have to go through the whole legislative process, and that has to be prepared. And you saw also this morning European Parliament saying, I want to know what's going on there. So I think there's a process that we need to follow, and that has to be a public debate about this.
Thank you. I think that clarifies that issue, which I think people might want to know about it. Now, Mac, let's move on to the other side of the globe. And you've been an old hand in this debate, as people can see from your CV. So what would you say now as an insurance philosopher about what would you want to see in a global standard? And particularly is an issue that you're also keen about is the valuation. There's a big debate. Should it be harmonized valuation before we can have a global standard? How do you look at that?
Okay, thank you very much. So actually, I'm traveling around the world and very, very happy to be here. Actually, I'm physically a New York resident, but I spent only 1 day this month, and I'm traveling around the world. For example, Malta is my 18th country I visited so far this year, and I tend to be in different continents every week.
Where are you taxed?
So, yeah, in New York. And
okay, good.
And then if you like physics, it's like almost like a geometric Brownian motion.
Mm-hmm.
But anyway, so the reason that I visit many different countries that currently I'm chairing the project called the APFF Insurance and Retirement Income Workstream, which was is endorsed by the APEC finance ministers last year. So we are working on how to promote long-term business and long-term investment, as well as the response to the needs for aging in the Asia-Pacific region. And I'm visiting one by one the different APEC jurisdictions and exchange our views, also the information and the different challenges that they are facing. And then we feel that maybe different responses and solutions might be needed to capture those different aspects. And then currently, this project has a very high level, 3 positions in terms of the global standards. The first, as probably it's in line with the European industry, but bank-oriented regulation should not be copied for insurance. And what's interesting to know is that our work stream, only 50% of the membership are coming from the inside of the insurance industry, and we work together with the bankers and securities industry and also regulatory community, ADB, ASEAN, and other regional organizations, and we are trying to have one voice on that matter. So Basel III should not be copy and pasted for the insurance company. That's good for the region. And when I talk about that to a Japanese colleague asked me a question about English vocabulary. So I talk about copy and paste all the time, but shouldn't it be cut and paste? And I told them that, well, it's copy and paste, I think, because otherwise it'd be too good for banks. Cut and paste would remove Basel III requirement from banks. That's not fair. And then second point is the economic-based variation. So we believe that the economic-based variation should have a long-term vision. But the short-term-minded economic-based variation, which need immediate action, would not be good for the region. So in that sense, I visited Santiago de Chile last month because the most recent ABAC meeting took place in Santiago in May. And there I have to have the progress report on this project. And I draw attention to the Spanish language. I speak Spanish because when I was studied in a French business school, I had a choice between Spanish and French tax system. And I thought the Spanish was much easier. And then,
so probably true, by the way.
Yeah, by the way. So the distinction, and I draw attention to the distinction between estar and ser in Spanish language. So in English, you say it's good, just it's good. But in Spanish, if you say está buena, it's about current status. So it's good for now, but you never know about future. But if you say es buena, it's more permanently good. It's about the nature. So you may probably know by now that I'm not a shy person, so no soy tímido. But when I'm in front of the beautiful ladies, estoy tímido from time to time. So that distinction is
you see, everybody understands you.
Yeah. So that distinction is absolutely essential for insurance companies or long-term investors, because we don't care if está buena or no está buena. It's just temporary. But we need to judge which company es buena and which project is bueno for us to have a long-term investments. And then, so about current discussion about maybe fair value measurement, and the fair value through profit or loss, interest rate up to basis point, and maybe liquidity spreads or all. It's all about estar, but this is not the transparency we need as a long-term players. So furthermore, the requirements for us require us to estar buena at any moment, and it makes it difficult to ser buena in the long run. This is a challenge. This is the challenge that we are facing. That would make it difficult for us to support long-term investment and funding. So now we are sitting together to establish the list of the constraints, and we are trying to have a high-level recommendation on that matter. Lastly, that we think that the one-size-fits-all does not work. So in the APEC region, so the wide range of the business model exists. It's very, very difficult to capture all the different manners in one-size-fits-all. There is a fear among the APEC jurisdictions that maybe if you develop the international standards based on the specific jurisdiction, which may have an unintended consequence for the other jurisdiction. Think about food regulation, and someone just draft the regulation, so all the fish should be cooked with heat before serving to the table. That would destroy sushi industry. The life without sushi for Japanese is something like life without drinking beer for Germans. So it's very difficult. So we should capture all the business model that exists in all the countries in order to call it as international standards. And talking about sushi, so you may probably know that the quality of the fish is very, very high in a sushi restaurant. But if you require the same quality of the fish for the restaurant which cook fish, it may be excessive. So the identical requirements imposed on top of the different business model, different stage of the development, different legal framework, regulatory framework that is existing there, that would not ensure the true comparability, that would not ensure the level playing field because of those differences. So we want to have an outcome which is reasonably comparable based on the existing differences. This is one of the policies that we have.
Well, that sounds very interesting. May I continue fishing into your pond?
Okay.
I wanted to know a little bit more about the question I asked you about evaluation. Do I read you right that you say let's all go back to historical cost accounting?
Okay, that's a very good question. Actually, we do not say that the economic-based variation is useless. For example, if you look at the Japanese experience, so for example, I entered the life insurance sector in the middle of bubble economy. At that time, the interest rate was very high, and at that time, the euro meant to euro beat, and I was busy dancing in a discotheque, and no question about the euro crisis. What a good time we had. And the stock market...
Maybe we got the crisis because you had a good time.
But problem is, we saw that the stock market is going up, my salary is going up forever. It was not the case, unfortunately. So interest rate went down. That created a negative spread problem for Japanese companies. But of course, we just revise our guaranteed interest rate for the future. So that negative spread is diluted as time goes by because the negative spread problem is decreasing as time goes by. So the situation is improving gradually. And then we internally use economic variation to make sure that we are just changing our direction appropriately for long term. So the issue is that we think that the management of the insurance company is just like Queen Elizabeth. I mean, talking about a big ship, of course. So now you're taking the ship, but we are not the F1 driver. So we don't change our direction immediately, just like this. It's like a security people. So, and then, but if you make a mistake in a direction, and if it is a long, long, long time, long way to go, just starting from Malta, you're going to the New York, but you may end up arriving in Buenos Aires. So that's why we need to have an economic variation in the long-term vision. But if we need to change our position, we don't take immediate action. We just gradually changing because we have a lot of time waiting. So we don't have to settle all the liability. So we can choose the right timing. That's good for the consumer because we don't lose the money in the financial crisis time. And it's good for the system because there's no systemic or procyclicality issue. We just gradually changing. So this is what we are doing. And I think another analogy, the philosophy. So if the species are living in the world of two dimensions, for example, like living on the piece of paper. So those people think that jumping out of the paper is nothing but taking risk because you don't know the future and you don't know the vertical world. But as we are living in the world of these three dimensions, we know that sticking to the paper would be very risky because someone put the fire on the paper, they're all dead. right? So now, as a life insurance company, we are living in the world of 4 dimensions, including timing. So we have a good time, we have a bad time, we have a diversification over the time. So whatever the situation, current situation is, we would like to be the best company for the entire life of each customer. Okay? So we can look, but the people who are living in the world of 3 dimensions tend to see everything in the snapshot. For those people, having a long-term business, having a long-term investments is nothing but taking additional risk. But for us, so it's a short-term business is even more risky because you have to have a settlement immediately. So if you have a crisis, you have to give the responses today. But we can wait. So this notion is not very recognized in the current discussion of the snapshot-oriented requirements. This is something that we have some skepticism, because don't pretend to know the future. The future is very mysterious. So no one can tell the future. So today you talk about Solvency II, but when I was younger, we talked about the movie called Back to the Future 2. So there are a lot. You remember the taxi was flying around and you don't even walk. We can jump with the floating devices to any destination. Do you remember which year it was? It was 2015, even before Solvency II. I don't think that even the Honda can make it. That was the best estimate when the movie was created in 1989, only 25 years ago. And I was just wondering if actually your valuation was a reliable one, because the people don't fly, the car doesn't fly. So this is what I'm talking about. For example, if you, so we have some issues, for example. We can have issues maybe in the foreseeable future, but something coming from the very far away, like 40 years and 30 years, we see interest rate motion, huge volatility coming. So all the foreseeable future is negligible compared with something coming from the very far. So this means that economic-based variation would not give us a solution to deal with the foreseeable future. So let's say that we are going to New York, and you see iceberg in my way. What would you like to do? So we want to go around, right? But when I'm about to avoid this iceberg, I hear the voice from the sky. No, you can't. You're going to Africa now. So this is something that we'd like to avoid.
Well, that is very, very clear now, the direction that we are heading. You see, with some good old Japanese philosophy, we would have been far ahead. But let's go back, Mike, to the, to the reality of every day. How do people look in the US to a global capital standard? And if you were to pass a message today, what are the things that you want to see in such a standard?
Well, thanks for the question, Carl. And this is a very tough act to follow. I don't think I'll be able to match Mac's linguistic, sushi, trans-dimensional philosophical views on capital standards. But I will do the next best American thing and use sports analogies, which we're very good at. And I know the theme for this conference is the challenge of change. But really, given the timing, it should have been the World Cup of insurance regulation. And you'll forgive me, but as one of the few American regulators in the room, I feel like I find myself in the dreaded Group G, the group of death here, surrounded by many of my European colleagues and their formidable views and approaches in implementation of Solvency II and the pursuit of capital standards through the IAIS and domestically, all of which you should certainly be proud and congratulated for. It's an issue that on the U.S. side, for a very long time, we played defense against that formidable offense. And, we raised what I think are and were and continue to be very legitimate questions about exactly the ones that I think have already been raised. Why are we doing this and what is it? And I think those are still questions that the fact that we're raising them, 3-4 years into the COM frame process suggests that they are somewhat still unanswered. Nonetheless, it is clear that this is a direction that the world is going into, and we have always been supportive on the U.S. side of the notion of that capital is an important component to COM frame and to the process coming out of the financial crisis. I think the initial thinking around that was it could serve us well as a very effective analysis tool, just as we have at the legal entity level a number of capital-related analysis tools to ensure that our companies are appropriately capitalized. And translating that to a global scale was, I think, something that we were all supportive of. But over time, that has morphed from an analysis tool to more of what appears to be a requirement. I mean, we're talking about the BCR, the R being requirement, and an ICS, the S being a standard, which should certainly, even though we're separated by a common language, to us in the U.S. would certainly seem to indicate a more prescriptive approach to this issue of capital. And I think that's where we have our concerns. But what you've heard from the U.S. delegation, and that includes my colleagues both in the U.S. Treasury now as well as the Federal Reserve, is a supportive notion of capital. But this is where I return to the U.S. soccer team. We may not have a great offense, but we've got one heck of a goalkeeper. And if you're going to get this capital standard across the net in the U.S., it's going to have to meet, I think, certain issues, requirements, conditions. And those are many, again, of the things that we've talked about, that it not be bank-centric, that it be flexible, that it not override existing legal entity standards. And those are really important issues for us. And then you can certainly get into the weeds on some of the approaches. I think a discrete use of models, sensitivity to let's not overhaul GAAP, let's make fine-tune adjustments so we don't recreate valuation standards. So those are the issues and ideas and concepts that we're bringing to the table now as part of the discussion. And it's unfair, I think, in some ways to characterize this as a Europe versus U.S. when it comes to this issue of capital standards. We're all essentially playing on the same team, but I think we have different ideas about the strategy we need to get the overall ball of creating an effective global standards across the line and into the goal.
Well, it's very, very interesting what you're saying, Mike, and I'm going to ask the same question that I asked to Klaus. How are your troops aligned on the U.S. side? Is there a side of, you were suggesting that there is a cooperative spirit now? Is this very cooperative, or is it still spirit?
There is spirit. I mean, again, I think, again, it's a big country with a lot of diverse opinions. I would say when it comes to the regulators in the room, especially the state insurance regulators, the Federal Reserve, who is now very involved with our domestic SIFIs and certainly involved in the GSI counterpart of it, there is agreement that we need to engage on this issue of capital standards, that we need to come to the table with an approach that works for the U.S. just as passionately as we heard from the European delegation about the need for a standard not to undermine the work that's been done with Solvency II. We certainly appreciate that view, and we feel equally strongly don't undermine the work that we've done on the state side and through Dodd-Frank. What's more interesting, Carl, is from a legislative perspective, there is increasing interest by our Congress, by significant folks in leadership on this issue is bubbled up, and I was at a hearing for our Treasury Secretary Lew, where he frankly got some very tough questions on the issue that we're here talking about today, and that many of us are at the table. And there were very fair questions about, again, the transparency of the process and truly whether or not the standards that are being developed are standards that are in the best interest of the insurance marketplace, or really, to Mac's point, are a cut and paste job of banking standards.
I think that's very important what you're saying, because it basically means, first of all, your message that in the US, the idea about capital apparently is perceived differently. I do remember
I'm sure
last
you do.
year's panel,
Sure
when I
you
was
do.
talking about capital, I was almost shocked, you know, we were not allowed to talk about capital. I think that's very positive. I think that we're moving on both sides of the pond, the big pond, and in similar direction. Ladies and gentlemen, time is moving on, and I have you on my scenario that I should ask you now, whether there are any questions from the audience to our panelists here. And again, as this morning, if you have a question, please state your name and the organization you are working with or which you pretend to be working with. So can I see some show of hands? There is one there on the 4th row or so here in front. That's Dave, isn't it? As the mic is coming. Yes, please.
Dave Snyder, Property Casualty Insurers Association of America. I want to thank Insurance Europe for this and for inviting us. Question, what problem are we trying to solve with this, and where are the points of agreement and disagreement, and how should we move forward? Because I think the insurance markets worldwide need a resolution. Thank you.
Okay, I think that's a very analytical way of looking at it. Before we solve the problem, what is the problem? Tom, I sort of hinted at that already at you. Is there a problem?
Well, there, potentially yes. Obviously, we just heard from, I'm sitting somewhere in between Europe and the United States.
And
by
Japan.
my accent, and Japan, right?
Yes.
But also by my work practices. And what we've heard is that there's a desire for each of the local, for the national regulators or regional regulators to preserve what they believe is a core of their system. Now, when I have, I don't want to use a religious analogy, but when I have two very strongly held opinions, then I question whether there's going to be conversion or accommodation. So I think if I had to point to what is an issue here, it goes back to the statement that I made earlier. If the BCR, if the ICS was a non-binding, but rather more an indicative tool to be used across a college of supervisors to actually get a conversation going that was meaningful, we would probably have a situation of accommodation, and the whole problem of conversion would be lessened to some degree. It's easier to live with each other if we have fences and we talk the same language, but trying to go for more is a little bit more. So I'd say that's a problem. Now, that wasn't the problem that you were asking for. What you were asking, what is the problem for global supervision? And for the insurance industry as opposed to banks, where banks can tend to shift money around at like a hot potato on a cold day, I would say the issue that we need to address from an insurance perspective is if local regulators are happy with their solvency regime, right, we need to be able to translate that happiness into 5 or 10 scenarios such that you can converse across it, and we need to make sure that dividends and intergroup transactions are appropriate, because those are going to be the ones that actually connect across regimes. Developing an entire conversionary capital standard to get at those two critical issues is it's an atomic weapon to kill a fly, right? So I would say the problem that we're really focusing on is cross-border systemic risk and getting a better dialogue going. And I think there are probably easier tools than a complete religious conversion.
Yeah, well, Mike, do you follow that reasoning?
I think what the reason Tom has laid out makes a very good case of what I would hope, the problem is that we're trying to solve. What I fear the problem that we're trying to solve is the question of the fungibility of capital. Because the direction we seem to be going is to drive the location of capital at a group level, which would again suggest that we're looking at that capital being fungible in nature. And again, as a legal entity regulator, and I know there are a number of us in the room, that raises all sorts of issues and concerns if we're talking about the free movement of capital away from legal entities, because I think has been highlighted any number of times during this excellent conference. one of certainly my goals, but I think one of the goals of the IAIS is policyholder protection. And capital is central to that, especially in a time of crisis. So if we're driving in the direction of the creation of a standard that at the end of the day, what we're talking about is creating a pot of money at a group level that is somehow movable and accessible by regulators other than legal entity regulators. That's a whole different dynamic, and that's a discussion. If that's the direction we need to go, we need to have.
Okay, Klaus, and then Mark.
Yeah, I think I mentioned at the beginning, one thing is GSI financial stability, because I understand the judgment also by the FSB is that there is a real systemic problem. And if that is so, then maybe you have to have a particular look at that and also look in particular on the, at the non-traditional activities that the insurers are carrying out. For the internationally active groups, I think it's a bit different. The question is, can the case be made that they actually, all of them, it depends on how they will be chosen. It's definitely important. And secondly, I think it depends on internationally active implies obviously that you're active across several jurisdictions. And obviously if you are active across several jurisdictions, then you can have an interest in having a level playing field and rules that are as close as possible. And here you also have the link obviously with the equivalence processes that we have also bilaterally to a certain extent. Because obviously the more on a multilateral basis systems are moving together and the more there's supervisory convergence, the easier it will be to recognize other supervisory systems as equivalent. So I think there's also a link there. And the question is, can we achieve a deal at the global level, such convergence, or do we need to pursue a more bilateral route?
Okay, Mark, what do you think?
Yes, I feel I hear a lot of times the word comparability when they talk about international capital standards. But I think we should define what would be the purpose for the comparability, because comparability should not be the objective of the standard setting. The objective should be something written in a bylaw. So you should have a protection of the consumers, maybe effective markets or financial stability. Those are the objective. Comparability is just a mean to achieve if it is appropriate. So talking about the comparability, for example, how about the comparability for consumers? So generally speaking, in Japan, the consumers were required to purchase the insurance products from those companies which have license in Japan. For those people, the comparability among the companies who have license in Japan are the crucial point. And then, and how about then why you need comparability among the different international companies? Maybe if you have the stockholder who would like to increase the exposure to the stocks, whatever the country is, that person may be interested in having identical variation. So maybe they think that this is a comparability, but I don't think that those people would be the core of the protection of the IAIS. So then, what would be the other matters? So then maybe related to Michael's point, but maybe it may be good to discover how much money that may be available in the group level when something happens. So in that case, we have to define what would be the risk that you want to avoid by having that. So maybe the objective of the capital requirements may have a different solution in terms of variation and other matters. So first, you have to make sure that this is for this purpose. That's why the variation is like this. And then you take into account a different perspective and then try to avoid a situation that you don't have enough money to create a confusions. So probably this is something that we should deal with coming from the financial crisis. So again, I don't think the identical variation and identical, the comparability, the pure superficial comparability would be needed.
You wanted to come back to?
Yeah, I just wanted to make one comment with regards to level playing field. I wanted to borrow the DeLorean from Back to the Future too, and I wanted to jet out maybe 70 years from now, maybe 100 years from now, when we have one international capital standard across the globe.
That soon?
Yeah, so maybe 200 years. Look,
Okay.
the DeLorean's a car built to last, who knows what. But let's suppose that we get there. Great, and then suddenly I've got this vision. I'm a visionary, I see the comparability. We had that same vision with IFRS 4 Phase 2. We had that same vision with a variety of different things. And the reality is that the step to that vision is a sequence of smaller steps. And these smaller steps actually create an unlevel playing field. Up until a while ago, I was on a level playing field in the United States. Why? Because I had to meet US standards, which were apparently fine for our US regulators. I mean, they felt comfortable about it. I assume that it felt fine. But now, as a European firm with a relatively more conservative Solvency II standards, I'm suddenly on an unlevel playing field because of those standards. So these incremental steps along the way are actually costing me and raising business issues. Do I want to stay in the United States when ostensibly the relative capital standards for various products could be on the order of 5 times higher under the two regimes? So if we're doing this for level playing field, then you're doing it for something that's going to be well beyond my date of retirement. I mean, that's literally the DeLorean, Back to the Future too, because I don't think that's going to happen anytime soon. And in the meantime, we are going to layer on different constraints, unless there is a globally binding, or it has to be not binding, which is the more likely. You're going to layer on different constraints which are actually going to make different jurisdictions look less attractive and create an unlevel playing field. That's just the reality.
Okay, it's a very interesting perspective. Any other question? I think we've time for one more question. Yes, the second row there.
Hello, Louis Woodall, Insurance Risk. It seems that ComFrame and systemic insurance measures envision the supervisory college as the prime tool to supervise these firms, but there seems to be a lack of clarity on what different roles should be to the group supervisor and to the participating supervisors. And I'm wondering what sort of division of responsibilities the panel thinks is appropriate.
Yeah, that's raising a rather different question, but maybe we can have a short reaction of everybody. Mike, group supervisor, college of supervisors. How many group supervisors do you like to have in the US?
Well, I mean, ideally, you don't want to have any more than one group supervisor.
Excellent. We love that.
Yeah. Otherwise, it becomes very confusing for everybody in the room. But
yes.
And we have, by and large, been very successful in the U.S. and also in Europe with the designation of really the appropriate regulatory authority for the role of lead group supervision. Commissioner Tom Leonardi, who I know who was here last year, is very passionate about, as he is with most things, about the issue of group supervision and the success we've had through supervisory colleges. And the role that a group supervisor plays is another area where I think there are a lot of good conversations that are going on right now also within the IAIS as to what the role of a group supervisor is. From a U.S. perspective, it really is first amongst equals. There are certainly powers that it should have in terms of coordination, gathering and disseminating information, and leading the college process. But in our view, that doesn't supersede the legal entity, regulators, domestic authority in any way. So we view it very much as a collaborative, cooperative process where a group supervisor is sitting in a chair role, but whose powers really don't exceed any other regulator who is sitting around the table, again, from a legal entity basis. But that process continues to evolve. I think generally we feel very good about what we're seeing in supervisory colleges. We talk generally about the development of ComFrame and when it will be implemented in terms of the capital standards. Group supervision is already in progress, and it's in play, and it's evolving, and it's doing just what we wanted it to do in terms of building the relationships between regulators and also getting a greater understanding of the group. So for us, that was one of the biggest lessons learned from the financial crisis. And to our collective credit, I think that's an area where ComFrame is already very successful.
Excellent. Mark, what do you think?
So in terms of the coordination among the supervisors, I have never found anyone who don't like a coordination of the different supervisors. So maybe if you have the common frame which increase the efficiency, and maybe so that regulators would act very consistently and communicating each other, that would be potentially very beneficial for the internationally active insurance group. So only if you just base the completely new requirements, which is on top of the existing requirements, maybe that would create a burden. So I think we should, based on the current practice, similar as possible to reduce the incomparability. For example, don't make the rule which is like to make the global apples to be consistent with global spaceship and great global bicycles, to make it impossible to compare apples in the country. So if you based on the existing one, and then if you have a coordination, that's the best common frame that you can think.
Okay, Tom.
We've had our College of Supervisors have been active now for 4 or 5 years, and I find it a very constructive construct. It's constructive in the sense that it is a single point for disseminating information, for raising issues, for discussing issues. If the issues are too specific, we take them offline, but it's a quarterly basis that allows us to get in touch with supervisors for information exchange, but also to open that dialogue. That dialogue would not normally happen on a quarterly basis with all the regulators, so the opportunity would not be there to begin with. So I find it a very constructive mechanism. It is true that, to the best of my knowledge, the group supervisor doesn't have any superior powers or any actions beyond the ability to disseminate the information and request it, which I think is fine. I still think it's a very valuable tool. But then we are a reasonably complex and large organization.
Klaus.
Yeah, from a European point of view, obviously, for us, group supervision is really key, and also because we think that if you look at, from different supervisors, you don't necessarily see the problems that are within the group, the intergroup transactions you can have, and okay, disseminating information is one step, but for us, that will not be sufficient, and that's also, as you know, the Solvency II framework, the idea of really a group capital standard, and the idea of having a real group supervisor that is looking at the group, which is basically a step further than just be one at the college disseminating information.
May I comment? The group is a virtual entity that doesn't exist. The group doesn't exist. Legally. I am comprised of legal entities. And it can be the case that I have a 200% capitalization ratio under Solvency II in all of my legal entities, but due to restrictions in terms of the recognition everywhere else, I could end up with below 150% group solvency, virtual group solvency, right? The group doesn't exist. It doesn't exist. It's the legal entities at the end of the day. And the group capital standard, it's an interesting information communication environment, and there may be something else, but literally, we are a set of legal entities.
Okay, but you have a holding company which is legally can give instructions to your so it's not you have legal entities, but there's a top that is leading the whole thing. Otherwise, you're not a group.
I think that we could continue that for discussion for a long time, but ladies and gentlemen, I think time has come to conclude this panel, and I was going to ask the audience before we started with a show of hands, who believes that insurance regulation is exciting?
Everybody in the room, right?
Oh, not that many. I'm very disappointed now because, as you saw, the discussion on global standards leads into sushi, into fisheries, into Queen Elizabeth, into sports. So it shows basically that it can be interesting. And if I may conclude our panel this afternoon, I think that we've seen that on the colleges, I think we have worldwide made a lot of progress over the last couple of years. And I think that's very positive. On the standards, we've seen that there's still a lot of resistance and reluctance. It's like, we love you, but we won't get married yet, That is still a long way off. So I think there's still work for Peter. You see, your troops are not aligned yet completely on this issue, and a lot of work will still be needed to do that. But maybe we should first of all thank the members of the panel for their willingness and their readiness to discuss such a difficult issue at this late hour in the afternoon. Thank you very much, gentlemen.